we are covering these 9 top actively traded stocks that are bullish today. While watching price actions, let us inform you our review on F. Ford Motor Company, known for its trucks, SUVs, and luxury vehicles under the Lincoln brand, has been stirring up some action in the stock market lately. The company, which has its hands in everything from traditional internal combustion engines to electric vehicles and vehicle financing, is seeing a surge in its stock after the announcement that price hikes are back on the table. Just a few days ago, the market was rattled by concerns over price hikes, particularly after some whispers that the White House wouldn't look too kindly on the move. But those worries quickly faded when former President Trump made it clear that he was all for American-made cars being priced a little higher, especially with the tariff situation in the mix. His words seemed to reassure investors that Ford could hike prices without facing backlash, sending shares up over 3% in one afternoon. While the price hike news is driving optimism, Ford's still dealing with some bumps on the road. A recall, this time related to a fuel leak in its 1.5-liter engines, is hitting the headlines. The recall affects Bronco Sports and Escapes from the 2020 to 2023 model years, but Ford's taking care of it with free repairs for affected customers. These hiccups are par for the course in the auto industry, but it's something investors need to keep an eye on as they weigh the stock's potential. On the brighter side, Ford has also doubled down on its brand image in Detroit, extending its partnership with the Detroit Lions for naming rights to Ford Field. This kind of move shows Ford's long-term confidence in both the team and the city, important for its local reputation. So while the recall might create a bit of noise, Ford's putting its money where its mouth is with moves that bolster its marketing and community ties. At the end of the day, this combo of price hikes, some short-term recalls, and solid marketing strategy is definitely creating some buzz around Ford stock. Investors are reacting positively to the price increase news, and the 3% stock bump shows there's still confidence in the company's ability to maneuver through challenges. But as always, Ford's journey is filled with both risks and rewards, and how they handle these ongoing issues will play a big role in where that stock goes next. Our review on LCID. Lucid Group Incorporated is making some serious waves in the luxury electric vehicle space, especially with their flagship, the Lucid Air. The company focuses on top-tier design, in-house production, and a vertically integrated approach, which positions them as a strong contender in the growing EV market. Recently, Lucid has seen a major uptick in orders, and it's being driven by a surprising source: former Tesla owners. About 50% of their recent orders have come from people who used to drive Teslas. According to Lucid's interim CEO, Mark Winteroff, a lot of these ex-Tesla customers are turning to Lucid due to dissatisfaction with Tesla's leadership, especially with Elon Musk's recent controversies. It's clear that Lucid is capitalizing on this shift in sentiment, offering a high-end EV alternative. This is a big win for Lucid, especially as Tesla is facing a rough patch. With its brand perception taking a hit, Tesla stock is down 35% year-to-date, and investors are getting nervous. Meanwhile, Lucid stock has climbed 4% in a single day, reflecting optimism about their ability to attract former Tesla customers. Lucid also reported strong fourth-quarter results, exceeding production expectations and delivering more than 3,000 vehicles. With plans to produce 20,000 vehicles in 2025, Lucid is well on track to ramp up its presence in the market. So, while Tesla deals with its PR issues, Lucid seems to be in the right place at the right time. The company's ability to attract new customers from its rival is giving it a boost, and investors are taking notice. Lucid's stock momentum could very well continue as they solidify their position in the luxury EV market. Our review on WBD. Warner Bros. Discovery Incorporated is a powerhouse in the global media and entertainment world, with a massive portfolio that spans everything from blockbuster films and TV shows to streaming services like HBO Max and Discovery Plus. The company operates across 3 main segments: studios, networks, and DTC direct-to-consumer, bringing a wide range of content to audiences worldwide. Recently, Warner Brothers has been in the news due to pressure from an activist investor, CELH Capital. This hedge fund, which holds a roughly 1% stake in the company, has been pushing for some major changes, including an expansion of the board and faster restructuring efforts. Specifically, CELH Capital has suggested that Warner Brothers explore spinning off or selling its cable networks to streamline its operations and focus on the more profitable parts of the business, like its streaming services. In response, Warner Brothers has decided to expand its board by adding Anton Levy, who recently stepped down as co-president of General Atlantic, to help guide the company through these changes. The news of this shakeup has had a positive effect on the stock, with shares rising by over 3% in just a day. Investors seem to be encouraged by the moves being made to address activist concerns, and the stock bump suggests there's optimism around the company's ability to execute on these restructuring initiatives. For investors, this could be a sign that Warner Brothers is getting serious about adjusting its strategy and maximizing value, especially in the ever-evolving media landscape. While it's still early days, the stock's reaction shows that there's confidence in the company's ability to navigate these challenges and emerge stronger on the other side. Keep an eye on how this all plays out, as it could lead to some interesting shifts in the media giant's direction. Our review on UMC. United Microelectronics Corp (UMC) is one of the top global players in semiconductor manufacturing, providing integrated circuit production for a range of industries, from consumer electronics to telecommunications. The company operates in two main segments: wafer fabrication, which focuses on producing chips to customer specifications, and new business, which explores innovative areas like solar energy. Now, there's some exciting news that's shaking things up for UMC stock. Word has come out that US-based chipmaker GlobalFoundries is exploring the possibility of merging with UMC. This potential merger comes amid growing concerns over the Taiwan Strait and increasing competition from China in the semiconductor space. A tie-up between these two companies would create a larger, more diversified player with a production presence across Asia, the US, and Europe. This move would likely give them a stronger edge in addressing global chip supply chain challenges and the shifting dynamics in the industry. Investors are clearly excited about the prospects of such a merger, with UMC's stock surging by 9.16% in just one day. The merger could offer a solid growth opportunity, combining UMC's strong presence in Asia with GlobalFoundries' reach in the US and Europe. If this deal goes through, it could significantly enhance the combined company's position in the competitive semiconductor market. For UMC, this news is a big boost, signaling potential for increased scale and global influence. Investors are reacting positively to the idea of consolidation in the industry, and this spike in stock price reflects optimism about what a merger could mean for UMC's future. Keep an eye on how this develops. It could be a game changer for UMC's position in the global semiconductor market. Our review on WMT. Walmart Incorporated is everywhere. Whether it's in your local store or online, it's a retail giant that's got a strong foothold in both physical and digital shopping. With its U.S. operations, international reach, and Sam's Club warehouses, Walmart is all about giving customers convenience, whether they're browsing online or popping into a store. Plus, it's pushing the tech side with things like Walmart Connect, which is helping them tap into the digital advertising space. Now, let's talk about Walmart stock. UBS just came out with a buy rating for the company, setting a price target of $112. That's about a 31% jump from where it's currently sitting, which is around $85. UBS is pretty confident in Walmart, especially with its Walmart Plus membership program, continuing to hold strong at or near record levels. That's a solid sign that customers are sticking with the brand, which bodes well for long-term growth. The stock jumped 3.1% on this news, which shows that investors are feeling optimistic too. Plus, analysts like Michael Lasser who has a pretty good track record, see Walmart as a solid bet in the retail space. On the flip side, there has been some insider selling recently, especially from the Walton family. It's worth noting, but it doesn't seem like a huge red flag, just something to keep an eye on. Overall, Walmart is looking pretty steady right now. With a strong customer base and an expanding e-commerce presence, the company seems to be on track for continued growth. The positive analyst outlook adds to that confidence, so it could be a good time to pay attention to this stock. Our review on PARA. Paramount Global is a major player in the media and entertainment world, with a strong presence across TV, streaming, and film. It operates under a few key segments like TV media, direct-to-consumer, which includes Paramount Plus and Pluto TV, and filmed entertainment, with big names like CBS, MTV, and Nickelodeon under its belt. Recently, there's been some buzz around Paramount stock, which surged nearly 3.5% in response to a staff change. The company's chief brand officer, Josh Line, left after 14 years to join Yahoo as its new chief marketing officer. Now, while losing a C-suite executive like Line might seem like a red flag to some, investors didn't seem to mind at all. In fact, the stock went up, signaling that they might be looking past this transition. After all, Line's track record at Paramount, especially with branding and marketing, was solid, so his departure to Yahoo didn't shake up investor confidence. Meanwhile, for fans of Paramount's Star Trek, Strange New Worlds, there's another update that's generating some conversation. The third season is getting some reshoots, with reports saying the season was considered too woke, and adjustments are being made. This decision, while it might please certain fans, also means a delay in the season's release. On top of that, there's some buzz about changes in the Star Trek franchise's leadership, with Alex Kurtzman possibly exiting by Christmas, which could be a big shakeup for the brand. Despite the staff changes and the behind-the-scenes drama in its Star Trek universe, the stock's positive movement shows that investors are focused on the bigger picture and don't seem too concerned about the short-term shifts. Paramount is still a heavy hitter in the media space, and it looks like investors are betting on its resilience. Our review on SBSW. Sibanye Stillwater Limited is a big player in the mining and metals world, with a wide range of operations across 5 continents. They specialize in mining precious metals like gold and platinum group metals, PGMs. Plus, they've got their hands in copper, recycling, and even working on tailings retreatment projects. Lately, the company has been making waves with its stock jumping up 47% over the past month. Why the surge? Well, 2 of its key European projects have just been recognized as strategic by the European Commission under the EU's Critical Raw Materials Act. This is a huge deal because it boosts Sibanye's role in Europe's electric vehicle battery supply chain. For example, the Keliber lithium project in Finland is expected to produce 15,000 tons of battery-grade lithium hydroxide annually, a game-changer for the EV market. On top of that, Sibanye's financial performance in 2024 has been strong. Their revenue rose by 7%, totaling our $56.9 billion. A lot of this came from higher gold prices and some smart operational moves, like closing underperforming operations and improving efficiencies, especially in the U.S. Their South African gold operations are doing particularly well, and overall, they've trimmed costs and boosted profitability. Analysts are taking note, too. RBC Capital recently upgraded Sibanye to an outperform rating and set a higher price target of $5.30. This reflects a positive outlook, especially since the stock had been underperforming compared to peers recently. With a solid balance sheet and these exciting projects in Europe, it looks like Sibanye is on the up and up. Today alone, their stock is up over 4.5%, which shows there's momentum behind the company. Investors are definitely keeping an eye on this one. Our review on CELH. Celsius Holdings Incorporated is all about those energy drinks with a healthy twist. Their main product, CELH, is marketed as a lifestyle and energy drink, and it comes in both ready-to-drink cans and on-the-go powders. They've also expanded their lineup with CELH Essentials and a hydration line. The focus on clean ingredients like green tea, ginger, and B vitamins has helped them carve out a niche in the energy drink market, and they're not stopping there. They've been expanding internationally too. Here's where things get interesting. CELH just acquired Alani Nu, a popular brand with women. This is a major move for them since the energy drink market has been largely male-dominated, with brands like Monster and Red Bull leading the way. By bringing Alani Nu into the fold, CELH is tapping into a fast-growing female market, which is expected to drive a big chunk of future growth in the category. Analysts are definitely taking notice. Bill Chappell from Truist upgraded CELH to a buy rating and raised his price target to $45, mainly because of the Alani Nu acquisition. Together, CELH and Alani Nu now hold about 16% of the U.S. energy drink market, and Chappell believes they could capture almost half of the female customer base in this space. On top of that, CELH is bouncing back from some recent struggles, like inventory issues with PepsiCo, and with stronger backing from Pepsi and Alani Nu's continued growth. There's serious room for the stock to rise. CELH has already had an impressive start to 2025, with shares up 33% so far. In fact, the stock shot up another 5.85% just yesterday, hitting a 6-month high. So, with a smart acquisition and a strong position in a growing market, it looks like CELH is ready to keep pushing forward. Our review on IPG. Interpublic Group of Companies Incorporated is a global player in the advertising and marketing services world. They've got their hands in everything from media and digital commerce to creative production and healthcare marketing. With well-known brands under their umbrella like IPG Media Brands and Axiom, Interpublic offers a broad range of services that aim to drive brand growth and engage audiences across multiple channels. Now, when we look at Interpublic's recent earnings, it's been a bit of a mixed bag. For Q4, they reported revenues of $2.43 billion, which was actually a decline of 5.9% year over year. They missed analyst expectations by about 3%, and their earnings per share, EPS, also came up short. Not the kind of results investors were hoping for, especially with a sector like advertising and marketing services, where growth is being driven by big trends like AI, programmatic advertising, and data-driven strategies. That said, it's not all doom and gloom. Despite the slower-than-expected quarter, shares of Interpublic did see a nice bump, up 3.31% on the day, which shows there's still investor confidence in their ability to navigate a rapidly changing landscape. The broader sector of advertising and marketing services has been feeling some pressure, especially with economic uncertainty weighing on ad spend. But companies that can leverage new technologies and adapt to shifting market conditions could still find growth. So while it wasn't a standout quarter for Interpublic, the overall market for advertising and marketing is evolving. If they can capitalize on these tech advancements and adjust to the new demands of digital marketing, they might find a way to bounce back and hit their stride again soon. For now, it's about watching how they navigate the changing tides of the industry. Please subscribe, give the video a like, and watch more from our playlist. Thanks.